Um, Hello guys. Once again, welcome to my show, The Stock Investing Simplified. Always remember my goal, which is to make you rich by showing you good stocks to invest in. So you buy them, hold them for 2 years, 3 years, or 5 years. As soon as they appreciate to the level that you want, then you can sell them and make the capital gain, which is your profit. That's my goal. That's all I'm doing here. Okay. Now, today, the stock of our interest today is the Altria Group. If you know Altria Group is a tobacco company. I'll put it this way: most of the cigarettes that you buy from um grocery stores or at gas stations are made by Altria Group. You can see some of them here: Salem, Marlboro, Newport, Basic, Palmer. Okay. So that's the company we'll be analyzing today to see if it is something that you can buy and keep and buy and hold, and while you wait for it to appreciate. Now, to do this, remember, like I said, Altria Group is a tobacco company. It's an American corporation, actually, and it is also one of the world's largest producers and marketers of tobacco, cigarette products, and other related products. And it is headquartered in Henrico County in Virginia. Anyway, my analysis will be based on the information I got from three main places. I would say 4 places. Some of the information come from the company's balance sheets. Some of them come from the income statement and cash statement of cash flow, and some come from the general stock information. Yeah. Now, I will take you to where we can get those information free of charge. Which other place is there than Yahoo Finance? So Altria, the trading symbol is MO. So I'm going to type MO, and then that will pull the company up. See? It's showing up, to make sure you're seeing this. Okay. It's not showing up. So I'll click on it. Usually, you can see the share price is down today. It's $41.49 per share, which means that it has room to grow. So for long-term investors, this is a good sign, because that means if you buy it at this price, it might grow. It has room to grow. But then let's see the performance of that stock over the years. I know, like I said, it's a tobacco company. There have been a lot of negative things. But the tobacco companies in general are victims of the arrows and slings of public opinion. They have been demonized, but in spite of that, so they're still strong. They're still there. The bottom line is that people will always smoke. So is human nature. I mean, some people quit, were able to quit, but more people are getting in. Besides, these companies are innovative. Innovative. There's this thing that they call e-cigarettes that more people are preferring than the regular cigarette. Well, if you want the regular cigarette, Altria got it. If you want the e-cigarette, Altria got it. So let's see the performance in general. For long-term investors, you're looking at 5-year performance, okay? So to do that, I'm going to go to the chart, company's charts, and then insert a 200-day moving average. So you can see the chart, see the ups and downs for the company. See, I'm going to make it, I'm going to use 5 years, okay? And I will insert 200-day moving average. Change the 200 days moving average. So for some of the time, and this is for how many years? from 2019 to 2020, July, all the way to 2024. Now, this company have been trading below the moving average most of the time during during the period under review. So, but the thing is that it is a little bit confusing here because the company have been paying dividend. I can see the D's. These are the dividends that it have been paying constantly every quarter. I mean, it is only the company that if a company is paying dividends, it is an indicator that it is a good company in many cases, not in all cases, in many cases. Because what is dividend anyway? Dividend is a share of the a share of the profit that a part of the profit that the company want to give to their shareholders. So if it is only when you are making profit that you will be paying dividends. So the fact that it's paying dividends, giving you a share of the profit means that it is still a profitable company. So that's why this moving average didn't tell us everything about the company, which also means that we need to dig more, dig deeper. So to do that, I'm going to go back and look at the statistics about the company. Okay. So the statistics about the company. So let's look at that. I'm going to click on the statistics we have, and then you can see what I need for this analysis. From this, you can see that let's start with profitability. Here you can see that the Altria group actually you can see that the profit margin is 42.61% and operating margin is 59.31%. So these high margins indicate strong profitability. So Altria's ability to retain a significant portion of its revenue as profit is really commendable and suggests operational efficiency. At this point, we are ready to look at management efficiency. We see that the return on assets is 21.78%. We don't have anything on return on equity, so let's go with return on assets. So this high return on assets of 21.78% indicates effective use of assets to generate earnings, which is can be considered to be a positive sign for investors, especially the long-term investors. Now, some things that we need for the income statement section, we'll be looking at the revenue and the earnings, okay? Then we also look at the quarterly growth year on year. Then probably, well, this trade will be good enough. Now, revenue of 20.56 billion and revenue per share of $11.53. Well, this revenue are substantial, but the problem is that it has a quarterly revenue growth of negative 2.50. So while these revenue values are substantial, the negative 2.5% quarterly revenue growth year over year raises concern about the company's growth trajectory. You see what I mean? Yeah, it raises a big concern about that because see negative 2% quarterly revenue growth rate of negative 2.50. Now, let's look at the net income of the company. See, net income is $8.74 billion with the diluted earning. Remember, net income is a nickname for net profit. So 8.74 billion with the net diluted earning per share of $4.90. Not bad. So this revenue, you know, we say that this net income and is high, both net income and the earning per share. So net income is high and earning per share is also good, is promising. But the quarterly earnings growth of, quarterly earnings quarterly earnings growth of 87.87% Okay. Maybe I would say that it's anomalous and should be investigated further. Yeah. After all, this is a company, so you have to dig more. This is a company you want to put your money in. You want to dig more to see figure out why this is this value. Now, now we can look at the balance sheet. Balance sheet, we have that the total cash is um total cash is 1.5854 billion. Now, but we'll look at the okay. The total debt. See, this is total cash right here. The total debt of 25.1 billion. So it's the significant debt level compared to cash reserve. See, debt level of 25.1 billion, 0.1 billion, but you have a total cash of 1.54 billion. So this high debt level compared to cash is a point of concern, potentially impacting the company's financial flexibility. Now, the current ratio is 0.33, very low. It means that for each $1 of debt they have only 33 cents to pay for it. So simply put, the low current ratio indicates potential short-term liquidity issues, and it has a negative book value of 1.92. Which can be, this negative book value, it is alarming, really. It's alarming. And it signals that liabilities exceeds assets. Okay. Now we can look at the cash flow statement. We need two things there, which is we're looking at the operating cash flow and the levered free cash flow. So the operating cash flow is $8.68 billion, and the levered cash flow is $12.06 billion. Well, I will say this. These strong cash flows are positive indicators. They are positive indicators, and they suggest that the company's ability to sustain operation and invest. They show that it has the ability to sustain the operation and invest in growth. Well, which is important. They can sustain. But worrying thing is this high debt, given that it is a lot bigger than the total cash. Now, how about this? Let's look at in general, the industry context and risk. Well, I would say this that the Altria operates in a highly regulated industry and increasingly socially scrutinized industry. So, generally speaking, the declining global smoking rates and the regulatory pressures that pose a significant risk to the business model of this company. However, Altria's potential to pivot towards alternative products like e-cigarettes, then cannabis, or cannabis-related products could offset some of the risk. Also, look at this. Another thing that I would say is that I think I have already said it, is that the company paid dividends. See, they paid dividends, which is really and they pay it constantly. You can see from the what they gave us before. Okay, it didn't show it here, but you can see it from the chart. See, pay dividends. So that is, see, so the dividends. So what does this tell us? A company that pay dividend, it is only when you have make profit that you pay dividend, in as much as the debt, you have a lot of debt, and their ratio of debt, the current ratio is 0.33 is low. We mean that, let's say that they have 1 billion in debt. That means they have only 330 million to pay to satisfy those. I'm talking about short-term debt. So debt is concerning, but they still pay dividends. So I will put it this way, that this company, Altria, of course, they have historically offered attractive dividends, which is a key factor for long-term investors. even though I mean, over the years, they've been paying dividend every quarter. So, and the sustainability of this dividend, given the company's financial health, is a crucial to assess. Now, in conclusion on this, I would say that Altria Group incorporated stock, they show mixed signals. Where its profitability and cash flow are strong. There are some concerns from its declining revenue growth, high debt levels, and industry-specific risk. So that means that for long-term investors, you have to be cautious. I mean, in the other cigarette company that I evaluated, I gave it. I mean, I know that the cigarette companies have this and been demonized for years, but they're still making money. But this particular one, I said I'm giving this debt level, and then for the other issues I mentioned, what would be the final decision? Is it to buy Ultra Group or to sell it? Well, the company innovates. Two, people still gonna smoke. Three, okay, let us look at um the graph again. See how, let me make it the maximum level past 5 years. Make it more than 5 years, the maximum. See what it will tell us. Okay, it is not at the maximum. See, with all the dividends. If you look at the maximum, let's say this was more than from 19, okay, I started from 1962 all the way to 1982. I can go even more. So let me start from 2003 to, I can even start, let me start from 2000, let me start from 2012. Okay. Now you can see, and in some patterns, in some years it is trading above, but most of the time it is below, hugging, either it hugs the moving average or it trade below. Well, from what in fact, let me put it this way: the signal is too mixed. It is too mixed. So I would say, whether to buy or not to sell, or to sell, I will put it for sell. That's my final conclusion. Sell. So the final answer: sell. Don't buy. Sell. So in my next lecture, I will look at other companies. So if you enjoy this lecture, uh, then subscribe for my channel. Subscribe, and then so that we'll be notified each time I have a new lecture on this topic, especially. Thank you for listening, and I see you in my next lecture. Have a nice day.